headwinds coming up ahead. And another concerning part that you mentioned, and I was going to mention as well, was the cap rates. And, cap rates are going to be much lower than the refinancing rates of these multifamily properties. And you want your cap rate to be higher than that. And so that's a big concern over there. And I've been reading a lot about multifamily potential supply coming to the market due to all those foregoing issues. So you're an investor in multifamily as well, in the distressed multifamily, is that correct?
Yes.
Are you looking in that market yet? Are you just being patient and waiting?
We're in that market, and patient and waiting means that we're looking at it and watching it and keeping it under surveillance, right? So we process a lot of data on a daily basis, and that data is being processed as we speak, and we just wait for the opportunity to present itself. So just to, multifamily is one thing, but back to the point you just said before about rates, there's a concept called debt yield. A cap rate essentially is the NOI of the property compared to the property value. And that's something that could change based on finding a buyer, right? But one thing that doesn't change is the cap rate to the lender. That's called the debt yield. That means the NOI of the property divided by the debt balance. And if the debt yields are less than interest rates, forget about meaning index rates, meaning the treasuries. And right, if you have a debt yield at 4%, I won't be able to refinance without coming out of pocket for cash. And this whole concept that people have dry powder, I love people. I need to deploy. I got dry powder to deploy. Oh, really? Hi, Mr. BlackRock. Nice to meet you. How you doing? But it's like, dude, you got some money. You want to invest some money. That's very nice to hear. Okay, you want to be fancy about it. Great. Okay, what's next? You have some dry powder to deploy. Or better yet, let's talk about the BlackRocks, the Blackstones. They got all this money to deploy. Where do you think it comes from? It comes from a lot of people, a lot of institutions that get it from a lot of people. Let's trace back Blackstone's money for a second, okay? Who invests with Blackstone? Who invests with BlackRock? Who invests with Starwood? Who invests with all these guys? Insurance funds, pension funds. Where do they get the money from? Well, insurance funds get it from insurance companies, get it from the premiums that you and I both pay on our insurance policies, and they go invest it so like that they can make a return, and they make a bet that the amount of money they're going to get every month back on the return is going to be enough to pay whatever claims they have. Or even a pension fund, same thing. They pay out every month the pension, same bet, right? So essentially, it's you and I, okay, that are investing through a bunch of people that are making money to make this great investment in these large institutions, and they're making bets. Well, when property values go down, they suffer, right? So at the end of the day, when you have debt yields that are less than interest rates, that means that you're saying that U.S. Treasuries are riskier than the property. No, I don't think that's going to happen. I think the property is riskier than the U.S. Treasuries, given all the things we discussed, which means you won't be able to refinance, which means there's going to be distress, which means there's going to be foreclosures, which means there's going to be sales, which means when you sell it, new buyers like, oh, I'm going to buy that. That's a problem. I'm going to give you a low offer. And that's how it starts. And that's how the issues are.